I want to continue where I left off. We have a lot of stuff to cover. Like I said, it's going to become, we're going to crank it up just a little bit more. Property analysis. When we're thinking about real estate, there are three ways in which we are going to analyze property. The first way is going to become the sales comparison approach. This approach is used primarily 4 units and under, because in the multifamily world, I consider a multifamily any more than 1 unit. So a duplex, multifamily. 3 unit, multifamily. 4 unit, multifamily. Okay? The second one is called the replacement cost approach. And the replacement cost approach is you're going to be dealing with regard to multifamily as well. I'm going to break each one of these down. And the third one is the income approach. The income approach has to do with how much income the property is generating. So if I broke each one of these down, the sales comparison approach, the definition of that is it's premised on the basis of substitution. It compares like properties of size, and characteristics in a given area during a given time frame. So we're taking all of the properties that have sold that are similar in size, in characteristics, and we're comparing those to our subject property. Okay? It's used for 4 units and less, so if you're looking at a duplex, a tri, or a 4-unit building, you're going to be looking at this technique, or your appraiser is. You're using a non-commercial or residential appraiser, someone that focuses on appraising real estate that's 4 units and less, and they're licensed to do so. And it's used by non-commercial or residential banks. This is what they're going to be focused on. What sold in the last year that has similar characteristics with size, amenities, things like that, and how does that compare to your subject property? Okay? Think of it almost very similar to the rent roll. If your subject property is here, 4567 West Street, and it's in the city of Springfield, the neighborhood of Forest Ridge, and the square footage of 1705, we're going to look at everything else that's sold in that neighborhood, that's sold in that city with a similar square footage or amenities. So if the price points came in at 139 to 127.5 in that range, on an upside market, you would probably expect your value to come in closer to the $139,000 range. In a declining market, you would expect for that property to probably come in closer to the $127,500 range. That's kind of how that works. Past sales are going to dictate value for your subject property. Okay? The replacement cost approach. The second approach that I think you should be familiar. What's that?
Question.
Oh, question. Yes. My mic guy's not here, but that's okay.
If you were putting an offer in, say, on single-family residences, but there's a group of 4 single-family residences in this one property, do you do a sales comparison on single-family residences, or do you have to compare and find properties that have 4 single-family residences on the one lot again? Like, how do you work?
So her question is, if you have a single-family residence and it's a lot of 4 single-family residences, how does an appraiser appraise that, right?
Or how do you do it for sales comparison?
Well, what I would do, that would be 4 single-family residences on one lot. He would probably look to see if there's other lots that have 4 single-family residents on that and use that as a comparable. That's what I would think that they would do. Okay? So the replacement cost approach. The definition is value by this approach is based on the current cost to construct the property. So let's say that you've got a 4-unit building. And the 4-unit building has a fire, it destroys it. And it costs $200 to replace that, okay? That's the replacement cost. How much does it cost to rebuild or construct that very improvement on that land? Typically, when you have a fire, by the way, you don't have to rebuild the land's already there, but you've got to rebuild the improvement on that land. So that's replacement cost coverage. It doesn't take into consideration the land value at all. Typically, that's used by insurance agents, and I put here not used by investors, meaning that it's not used by investors in making a decision of value. Replacement cost approach may come into play when you're starting to understand the dynamics of expenses with regard to insurance costs on that property. So that's when that may come into play with that. So the third technique or third way that we assign value with multifamily unit properties is the income capitalization approach. Now, this is where it starts to get a little tricky. This approach is defined by saying it recognizes the present value from future income. So if you think about our skeleton, income minus expenses equals NOI minus debt service equals cash flow. If you think about that and you go out over the next 24 months, you know there's a good chance that that income's going to come in, hopefully come in more than what it is today, but also that those expenses are going to be there. And we should have an NOI that we could, I guess bank on is probably the best choice of word there, but we could bank on. So present value, the value today, is going to be based on future income that comes in. Now that's the definition. Real world, and you as an entrepreneur and a real estate investor, you are going to get bombarded from a marketing aspect because people take a look at this definition and they try to sell you on something that's called pro forma. Has anybody seen those words or that word? Pro forma. Pro forma means basically this. Now if we move this to the side, pro forma means, hey, listen, if you buy this property and run it like it's supposed to be ran, this is what the NOI is. We're basically charging you or asking a sales price based on that new NOI. So I have a distinct issue with that as an investor, as a real estate investor, because if I'm doing the work to increase the NOI, I should be able to take credit for that. Why am I giving you that value? Because you didn't run this properly correctly. Make sense? Everybody see that?
So it's based on the potential that
it's based on the potential. When people are talking pro forma, they're trying to sell you on that. Okay? Penny.
Two questions. Number one, did you take into consideration reduction of concessions in there as well, or is that something separate?
Well, let me get to that. I haven't got to that yet,
Okay,
but let's.
Second question when it comes to pro forma. How often do you see the list price based on the pro forma?
Quite a bit, especially when you're using a professional marketing firm, a bigger commercial brokerage. So her question is, how many times do I see the list price based on pro forma? If you're using a CB Richard Ellis, Marcus and Millichap, Inland, all the commercial, they're going to base a lot of their asking price on pro forma. If you are dealing with a mom and pop or smaller brokerage, that's oftentimes not the case. And if you're dealing with an agency that is like a Century 21, a Keller Williams, a Remax, and sometimes they price properties wrong, but also they don't really take into consideration that pro forma. It's only when you're dealing with the professionals kind of thing. So that's kind of your answer. I'd like to just get through this rather than I got a ton of stuff to cover, and if we just save them right for the end, I promise you I'll get them, okay? The income capitalization approach is used for 5 units and over, so we specifically use this technique for 5 and over. Now, when you get an appraisal on a 60-unit building, let's just say, the appraiser's going to go out there and they're going to study that investment, and they're going to come back and they're going to write an appraisal that's an inch thick, okay? And in that inch thick report, that appraiser is going to actually take into consideration all of the approaches. You're going to see the sales comp approach, you're going to see the replacement cost approach, and you're going to see the income approach. Most of the time, when I say most of the time, I'm talking 85% plus of the time. On a 60-unit building, that appraiser is probably going to put most weight on value towards the income capitalization approach. There are times when they're going to put most weight on other approaches. For instance, the replacement cost approach, for instance. If you've got an empty building or vacant building, that appraiser may say, well, you know what, it's not fair to price this or analyze this or evaluate this as a fully stabilized apartment building. I am going to use the income capitalization approach, but I'm not going to put as much weight on that. I will put more weight on maybe the replacement cost approach or maybe the sales comparison approach. Do you see that? So it's up to the appraiser. That's the appraisers, that's up to them, how they're going to use that. But most of the time, 85% plus, they're going to put most weight on the income capitalization approach. And so should you. In a stabilized market, with a stabilized asset, that's where you're going to get its value. Now, make sure that your seat belts are fastened, because this is kind of where we get into this a little bit more. Do we have something?
I know I'm not supposed to ask a question.
You're like, I know what the rules are, but I'm going to break them.
They're not going to have all the documents that we have. How do they do an income capitalization approach?
Sure, they're going to have all the documents that you have. Absolutely, they ask for all that. Absolutely, they get all that. They all, and then some. They've got documents you don't have. Absolutely. Okay, so very simply, if I gave you a very simple example of this formula in red, which is present value equals income. When I say income in this case, I'm talking about net operating income divided by rate. I'm going to explain this rate in a moment. $10,000 of NOI divided by this rate of cap rate, 10% or 0.10 equals $100,000 in value. I want you to remember that formula. Value equals NOI divided by cap rate. That's one of the things that I want you to memorize. Value equals NOI divided by cap rate. Now, this cap rate, which I'm going to define here in a moment more thoroughly, is the market cap rate. Not the cap rate of the deal, but the market cap rate. I'll show you the difference here as we roll along. Just to back up a moment, what's the difference between the sales comparison approach and the income approach? Well, I think one deals with market opinion and the other one deals with financial performance. And let me kind of explain where I think the difference lies more. Have you ever heard the saying, if you want to sell that single-family house, you should focus on what? Anybody know?
Curbside appeal?
Curb appeal, right? Curbside appeal. I've never heard of it called curbside appeal, but curb appeal, right? Kitchens and bathrooms, very good. Why, though? It drives emotion, doesn't it? On the single-family house side of the world, which, by the way, includes 4 units and under, so it's going to include a 4-unit building and duplex, emotion is really driving that side of the world. And I wrote, about a year ago, I wrote a blog about the fact that single-family houses and this whole idea of investing in single-family houses. I wrote this blog that single-family houses were never meant to be geared as an investment. And somehow this has turned into not only an investment, but it's turned into a commodity here in the States. But we'll leave that for another time or another discussion. But single-family houses, 4 units and under, are really driven off the premise of emotion. That's interesting to me because we remove, as investors, emotion out of our decision-making process. You can see it when the single-family house boom was going on, by the way. When the banks changed their lending programs. Oh, you have a bad credit score? We've got a loan for you. Oh, you can't afford the monthly payment? We've got a lower interest rate program for you. Or we've got a teaser rate, as they called it. Or we've got the adjustable rate mortgage, or something called negative amortization loan, which was really interesting because when you paid less than the amount due, or less than the principal and interest on the payment, or less than the interest due, more principal got tacked onto the back of your loan. That was a real interesting thing they came up with. But all of those things let more people into the game. It was an auction. Has anybody ever been to an auction? Yeah, okay. I've been to, what about anybody heard of something called the Barrett-Jackson Auto Auction? You have? Okay. I've been there probably 3 times, okay, in the last like 5 years. Really cool. This is where they auction off all the old muscle cars and really cool stuff. And I sit in that auction room and I watch these people, and as the price gets ratcheted up, you see it in the people's eyes. You see the emotion take over. And, you know, I feel it and I'm not even bidding. And the same thing happened that happens in those auction houses for cars and things like that in the real estate world. As we let more people into the auction that had the ability to buy, it got ratcheted up. Not only the emotion, but the prices. And then when things changed with interest rates and our economy and banking, boy, it was like letting an air out of a balloon. That dissipated fairly quickly. So that's one side. The other side is financial performance. So when we're talking about the income capitalization approach, I'm talking about that formula that I just asked you to memorize. Value equals NOI divided by market cap rate. Just remember that portion for me right now. Where do you get this information, by the way? Where do you get the comps in the area? Well, you can certainly do that in a few different sources. Number one, you can get those from a real estate agent. You can get those from a residential appraiser. You can get those online. Where do you get the capitalization rate of the market? Same thing, real estate agent, appraiser, or online. An appraiser is a great source of information, by the way. You might want to call a commercial appraiser and say, hey, I'm looking at a Class B apartment building in Schaumburg, right off of Schaumburg Road, right by the mall. What's the cap rate in that market? What are things trading for there? Great resource to have. Residentially, you might get a comparative market analysis from a real estate agent or a broker price opinion from a broker. And that's a great resource. But have you ever tried calling a residential appraiser? Great resource of information. As long as you're not keeping them on the phone for, you know, hours and hours, and you're not guaranteeing that the information that they're giving you is exactly right, they're a really good source of information for you. So I would tap into that.